Welcome to March's Business Outlook press conference call. I have with me today Mike Trebbing, who's our Senior Economic Analyst, and I'm Marilyn Wimp, Manager of Media Relations. Mike Trebbing is going to be answering questions from reporters today, and we have joining us on the call Kathleen Madigan from Dow Jones. Please remember to mute your buttons during the call, except when asking questions. I'd like to turn it over to Mike, who's going to say a brief statement before we get started.
Thank you, Marilyn. Indicators from the March Business Outlook Survey suggest that conditions continue to improve in the region's manufacturing sector. Although indicators for new orders and shipments moderated from February, all of the broad indicators remain positive, indicative of improvement. The overall level of employment and average work hours among reporting firms also increased this month. Firms expect continued growth over the next 6 months, and nearly half indicated that they expect the rate of production to accelerate during the second quarter.
Thank you. We'll now take questions. Kathleen?
I noticed that the inventory index turned negative again. Do you have any idea if that the drawdown was unintended because sales were bigger, or if companies are getting back into inventory drawdown mode?
There's no telling from just the overall diffusion index, I think. We did receive a few comments this month that were, again, suggesting that some of the growth in orders were coming from stabilization of inventories or building of inventories of some of the customers. But, just from 1 month's reading of the diffusion index on inventories, it's really hard to make a judgment about that. However, as we indicated last month, the number did turn positive for the first time in some time. So, on a several-month average basis, that inventory number is suggestive still of stabilizing inventories.
Mm-hmm. Okay, thanks.
I believe we have another reporter on the line. Who joined us?
It's Ellen at Reuters.
Hi,
Hi.
Ellen. Welcome to our call.
Thank you.
We would entertain your questions now. Mike Trebbing just got started.
Are you starting with me?
So if you have any questions, Ellen.
Okay. It seems as if there might have been a little bit that the components of the index are a little bit more mixed than the headline number would imply, with orders and shipments a little weaker, although the employment picture looks a little bit better.
Right.
Forgive me if I'm repeating things you've already said.
Right, yeah, we saw like a 1-point increase in the general activity, but a slight fallback in both shipments and new orders. But in general, the trend is still positive, with positive readings on all of the broad indicators. Again, employment showing some increases on both the number of workers and average work week. So on balance, most of those broad indicators, were stronger in the first quarter than in the fourth quarter. So if you take out some of these 1-month fallbacks, there's still basically an improvement overall.
Thank you. That was Ellen Farlick from Reuters. Do we have another reporter on the call?
Hi, it's Courtney Schliserman with Bloomberg.
Hi, welcome. We're happy to take your question, Courtney, if you have one for Mike Trebbing.
I wanted to make sure I got it right on the special question. With the second part, when you talk about an acceleration in growth, is it that it's an acceleration in production growth or economic growth?
Right. We asked about specifically their plans or their expectations for production during the second quarter compared to the first quarter. Mm-hmm. And the first part of the question asked, what increase or decrease they were expecting over the first quarter. We got an average of 1.8% increase for the entire panel, with about 57% of the firms indicating that they were expecting higher production levels in the second quarter than the first. and a smaller percentage, 17%, expecting declines. And then when we asked them if that production growth rate was an acceleration or deceleration over the pace of the first quarter, we got that 48% of firms that indicated that the expectation was it was an improvement or an acceleration from the first quarter pace. And then we also asked them about whether the overall increase was due to seasonal factors or change in business conditions, and about 40% of the firms said that it was related to overall business conditions rather than just seasonal aberration.
Okay, thank you.
Do we have a follow-up, Dow Jones?
No, nothing, thanks.
Of Reuters?
Yes. Mike, about that special question about the average of 1.8% increase in the second quarter over the first quarter. That is 1.8%. It's not that's not like adding 1.8 percentage points to GDP. It's 1.8% over whatever the production was in the first quarter, right?
That would be a simple percent change from the levels in the first quarter. So
right. So in absolute terms, that's not that much, right?
Correct. I would not characterize that as rapid growth, especially as it relates to a recovery period after a recession. And most of the comments this month did reflect the fact that the pace of growth was improving, but we heard very many comments that suggested that it was slight improvement, modest improvement, and it does bear out in the special question where 41% of the firms said it represented some acceleration, and only 7% indicated that it would be characterized as significant.
Thank you. Any follow-up, Bloomberg?
No, thank you.
Well, if there's any other questions, any other callers? If not, we thank you all for participating in our press conference call, and we'll see you again in April. That's April 15th at 10 a.m. Thank you.
Thank you.
Thank you. Thank
Bye-bye.
you.
Bye.
Now I'd like to turn to Mike Trebbing just for a follow-up on what we heard today and what the survey says. This is, again, Mike Trebbing. He's our Senior Economic Analyst, and I'm Marilyn Wimp, Manager of Media Relations here at the Federal Reserve Bank of Philadelphia. Mike, our main index has been positive for the past 7 months, and historically has a series of positive numbers for more than 2 quarters preceded a recovery. Could you talk about that?
Right. On average, the General Activity Index has done a remarkable job of matching the official beginnings of recessions and the official recovery period after the end of a recession. And it's been no different this time. Our index was about at 0 in August of last year, and then finally turned positive. Most of the indicators in August, and some not until September. And since then, we've seen some improvement, as I mentioned in the call. For example, this past first quarter numbers, the numbers were still a little improved over fourth quarter. So it's also picking up not only growth rates, but at times even an acceleration in growth or improvement. Most particularly, I think, in the employment indicators, where just the last 3 or 4 months we've finally seen positive growth. And that's been also reflected in other surveys, as well as now national employment numbers that are showing some rehiring of workers.
I'm glad you mentioned employment, because I know that also the Business Outlook survey has been in positive territory, and this month the future employment index actually jumped. We saw it jump from 24.4 this month from 13.8 in February. So we're looking at some job growth in manufacturing. Is that
right?
How you would interpret that?
On the current side, although the indexes have turned positive, we're still only talking about 17% of the firms, for example, this month reporting increases in employment. and looking forward over the next 6 months, about a third of the firms, and that percentage is inched up a little bit. So we still have a majority of firms talking about no changes, and a small percentage of firms making cuts. But generally, the improvement is coming out in the employment numbers on both the current side and the 6-month forecast.
Is there any indication from comments from our participants about when we might begin to see real hiring?
Many of the firms are still, as I mentioned, mentioning in the comments, that the growth that they're seeing is slight and modest, and not nearly the pace that they would have expected in a normal recovery. And as I mentioned, many of these firms saying, well, a lot of the growth was inventory stabilization rather than final demand. And when we look at our numbers, the firms that are producing intermediate goods and capital goods, for example, are not doing as well as some of the final goods producers. So I think until we see aggregate demand picking up steam, we probably won't see much of an improvement on the employment side until there's a market change in demand.
Well, speaking of demand, new orders were down this month, and we did see a notable pickup in new orders in February. Can you explain this?
Right. This happens with these diffusion indexes once in a while. It didn't totally reverse the big jump in February on orders. And but again, if you look at it like a 3-month moving average, we're still seeing some improvement in orders. But it also is reflecting the fact that the pickup isn't broad. It's broad enough to get picked up in some of the diffusion indexes, but the pace maybe is not as great as one might expect at this time of recovery. And some of the firms did actually mention a flattening of new orders from last month. So sometimes the comments do reflect how these diffusion index get calculated as well.
Okay. One last thing I'd like to touch on, and you did answer some questions about our special question, and what I'd like to maybe do is contrast. We do ask some of the same questions consistently from year to year, and we ask about the changes that they expected in production.
Mm-hmm.
And 57% said they expect increases in production in the second quarter.
Right.
And is that surprising? And can you maybe elaborate on that? And especially in comparison to what we saw last year.
Last year, right. The nice thing about these kind of questions is if we time them correctly, we can have a benchmark comparison against a prior time period. And we did this last March, and during the middle of the recession, with hopes of an end of a recession. But there was a marked contrast, I think, with at that time, 45% of the firms expecting declines in the second quarter, and that number is down to 17%. And back in March of 2009. We only had 35% of the firms expecting increases, and now it's over a half. So I think compared to 1 year ago, we're in much better shape than when things were still in decline in March of last year.
Okay. Well, thank you for spending this extra time with me. You've been listening to March's Business Outlook Survey here at the Philadelphia Federal Reserve Bank. We want to thank Mike Trebbing, our Senior Economic Analyst, for talking about the survey and what it really means. And we'll be doing next month's survey here, April 15th at 10 a.m. So look for it then.